Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra, and the picture at 11 o'clock is so much better than what we started trade with. The Nifty had gone down to levels of nearly 2,400, and now we're above 24,250. It's been a solid 250-point recovery from the day's low. At the index level, we're up nearly 0.5%. The mid-cap index, small-cap index have recovered from the day's low, but they're still in the red right now. The picture across Asia also is a little bit better. So they've managed to cut their losses. Hang Seng was down about 2.5%. Now it's down 1.6%. The Korean market also in the red, but as I said, there has been a recovery from the day's low over there. And the key sectors which are seeing a pullback or driving the up move in the markets, IT is one. IT was the best performing sectoral index last week. It rallied 4.5% and it's added on another 1.4% today. PSCs are doing well. The Nifty banking index too is up close to about 0.8%, 400 points gain there. Hi.
Yeah, hey Reema, and in last couple of trading sessions, whenever we have seen that recovery, it's either come from IT or the banking index, and that continues to be the case today as well. In fact, there are a couple of stocks at the day's high. All of them actually are from the IT space, be it Tech Mahindra, be it Wipro or Infosys as well. So these three stocks at the day's high, that's something that is leading to the recovery that we are seeing on the Nifty as well. The banking name, so HDFC Bank, we have to talk about that name. That stock is up right now 1.1%. It is at the day's high yet again. And a lot of moving parts because we are also towards the fag end of the earnings season. Big reactions is what we are getting. We'll talk about Asian Paints in just a bit because that's the big casualty, a big fall there. And we've seen that if a Nifty stock is not meeting expectations, we are seeing sharper moves on the downside or on the upside as well. So let's talk about that. Asian Paints reported a weak set of quarter two numbers. Mangnam is here with the analysis. Mangnam.
Well, it was all-round weakness for Asian Paints. You know, there was weakness which was expected for the paint companies this time around. We did see that across all the paint companies that reported, but Asian Paints, which was the last of the companies to report in this sector itself and is the largest, has actually given the least amount of growth. In fact, it's declined by about 5.3% on the revenue, and that is causing the big decline that we're seeing in the stock price as well. That revenue decline was led by volumes. 0.5% volume decline is what the company reported in this quarter, and that makes it the first decline in volumes in the last 12 years for Asian Paints. If you adjust or remove the COVID exception itself, the revenues declined by 5%. The EBITDA declined by about 28%. Gross margins were down by almost 260 basis points, and the net profit fell by 44%. Yes, there was an element of exceptional in the net profit as well, which was basically an impairment of the investment that they had made in White Teak Co. and the forex loss in Ethiopia. But largely, it was weak consumer sentiment, persistent rains, and floods in some part of the country, which impacted their overall performance. The concern, however, is that could this also have an element of competition? Because the management has alluded to increased rebates and increased sales expenses in its commentary twice. And secondly, you also have the employee expenses for the company, which have increased. So if you're increasing your sales expenses or increasing rebates that you're giving to dealers, along with protecting your employees by increased employee expenses, there could be some sort of competition element itself. What we need to know is how much of that is played out in the third quarter as well, and how margins will recover in the third quarter with expected softening in raw material prices. The stock is down 27% from its 52-week high. It's at its May 2021 levels, trading at around 45 times. And remember, this 8% decline today has also made Asian Paints negative in returns for FY25. And in the last 20 financial years, Asian Paints has given negative returns just twice, which was once in FY09 and the second was FY23. Let's see where it goes from here.
Okay, thank you very much for that. Berger Paints, Kansai Nerolac also under pressure today, down nearly 2%. But Motherson Sumi Wiring reported their Q2 numbers. Profits declined 3% even as revenues went up by 10%. To talk more, we have the CFO Mahindra Chabra and the COO Anurag Gehlot joining us on the show. Thank you very much, gentlemen, for joining in. Mr. Chabra, the first question to you is on margins. We have seen a pickup in your margins in the first half of the year. Margins now stand at about 10.8%, but it's lower than the FY24 level of 12.1%. You had said that FY25 will see an improvement in margins. What's the margin range that we're looking at?
Yeah, sure. So first of all, thanks for getting us on the CNBC. Well, if we look at EBITDA for the period, in absolute terms, it's about 250 CR. And in terms of percentage, you are right, it has been lower than what we had in the last year. And it's mainly explained by the two new plants that we have put up, one in Pune and other in Navagram. And whenever we put up a new plant, there are initial costs. And as you know, our operations are labor intensive. So we need to hire people, deploy them, train them. And there will be initial ramp-up costs in addition to manpower also. So that is the reason we see kind of in terms of drop in the EBITDA. Having said that, as an organization, we focus on ROCE. And we have a guideline to deliver more than 40% ROCE, which we have been doing the last 2 years. And as far as current financial year is concerned, we are again on track to deliver more than 40% ROCE.
Okay, but on margins, just to complete that point, in H2, will we continue to see pressure on margins, or can it start recovering? Some guidance, some number.
Sure. So I would not like to comment on the EBITDA numbers as such, but yes, whenever we put up a new plant, it takes 6 to 9 months to kind of when the plant is fully ramped up. And ROCE will keep on focusing, will deliver more than 40% ROCE.
Mr. Gehlot, coming on this one, when will these, are these plants functioning at fuller capacity, or they are just commissioned, they are starting and it will take some time for you to fully commission or start the operating capacity there? And how much will it add to your overall capacity addition?
I think as Mahindra has commented that there are two greenfield projects, and one of them already the SOP has started in one of the customer, and there are multiple customer on this site, and other customers will be ramping up in the Q4 and the Q1 of FY26. The other plant, the customer has delayed the project by 6 months. So I think it will take as Mahindra also suggested, that 6 to 9 months time to get a full ramp up onto the plants.
So is it then when you will see margin improvement? Either of you can answer that, because you're talking about return on capital employed. But what happens to margins? Will FY25 be lower than FY24, and it'll see an improvement only in FY26 when these plants do get commissioned completely?
You have to understand that, we are running with 28 plants. Out of that, 2 greenfield are there. When our capacity goes, to 80% plus, we started expanding ourselves on behest of the customer firm orders. So growth is happening. Customer is trusting you to giving the new orders. Without these 2 greenfield project, you have seen the EBITDA numbers also. And, it's just a matter of time. As soon as the volumes will ramp up, you will see a good positive results for these 2 plants also. As far as expansion is concerned, all the customers, major OEMs, in the country has started giving their numbers, what they are expanding. And I think we are very much aligned with that. So once they will grow, and we take a challenge to the chin that, we have to do what customer is asking us to do. And we are not doubting their volumes also. So I think it is going to be a very, very positive in the future. It's just a matter of time when the these plant ramp up completes.
Mr. Chhabra, X of this particular issue, that there are new greenfield plants and there is investment, etc. Have even raw material costs gone up for you, copper in particular? And what is the outlook on raw material prices in the second half of the year?
Yeah, sure. So as far as raw material cost is concerned, it's a combination of various factors. Copper is one of them. And the other big one is the product mix. As far as copper is concerned, yes, Q1 there has been increase in the prices of the copper, which has slightly cooled down in Q2. But as an organization, we have a pass-through arrangements as far as copper prices are concerned with our customers. With some customers, we have this adjustment at a quarterly lag, while for the other customers, it is at a half-yearly lag. So if you look at the copper prices over a period of time, it doesn't really impact our P&L on account of the fluctuation in the copper prices.
Okay. Your focus has been SUVs and EVs. They require higher wiring harness content. What is the current percentage of revenues or volumes coming in from SUVs and EVs in the total portfolio? What will it look like in the next fiscal, Mr. Gehlot?
See, it is very difficult to bifurcate between the SUVs and sedans and things like that. But yes, for EV, we are approximately 4.1% of our percent of the revenue for the Q2. And I think we have grown by around 40% in EV sales if we compare year on year also. So we are very much aligned with what customers are making and the volumes they are giving. And you will see in the future also, because we are part of this beautiful journey of the customer also, where we are part of the EV vehicles.
Okay. You have mentioned that you're actively exploring new opportunities within the evolving automotive landscape. If you'd like to just talk about what more in terms of a strategy or development should we expect?
See, all of the major customer in the OEMs in the country, they've already given their numbers. Whether we talk about Maruti Suzuki, already given 4 million spread of 6 to 7 years of period. Mahindra has also announced their investment earlier in the year. Tata has bought a land in Vellore, and they have bought a plant in Gujarat. So when you are seeing that much of expansion in the customer, and we are a company who don't doubt on the customer numbers, so we are also expanding ourselves. We are a wiring harness manufacturer as MSWIL, and I think we are working with customer very, very closely on all their volumes. And we are also an engine agnostic organization, so we can work on anything, whether it's ICE, EV, CNG, hybrid, or anything you talk about today.
Okay. All right, Mr. Chhabra and Mr. Gehlot, thank you so much for joining in today and talking about your future plans and the expansion plans as well. Have a great day ahead. Well, that's the word coming in from Motherson Sumi Wiring Limited. For now, we'll slip into a short break. When we come back, we'll discuss what's buzzing in commodity space with Manisha Gupta. Stay tuned for that. Welcome back. We spoke about the equity markets. It's time to shift focus to the commodity space. Manisha is joining in, and today we are focusing on Bitcoin. Manisha, what a move here.
Well, absolutely. As we've seen President-elect Trump come in, this is going to be his second season, and he has promised friendly rules and regulations and papers when it comes to cryptocurrencies, and is the reason that we've seen very, very strong gains since the election day to today in many of these cryptocurrencies. If you look at Bitcoin itself, we've seen an all-time high of 81,000 come in for this one. It was trading quite strongly and with big volumes on Sunday as well. Remember, it's 24/7 and all 7 days of a market, and we have seen strong gains and strong volumes come in over the weekend as well. If you look at the Bitcoin ETFs in US, those also recorded an all-time high $1.3 billion of a one-day flow there. Overall total market capital, when you look at the Bitcoin ETF, it now stands at around $80 billion. Also, the open interest in Bitcoin futures, which are betting at $90,000, is also at a record high of $2.8 billion. I mean, that's the kind of bets people are putting in suggesting that you could be looking at higher highs from Bitcoins from here as well. The other token, the DeFi token, which is Cardano, also surged by 40%, and this is just about overnight market. If you look at the meme coins as well, we've seen 18 to 20% of gains come in for the likes of Dogecoin and Shiba Inu as well. If you look at the last 1 week, and that's the chart that tells you the kind of run-up that we've seen in many of these cryptocurrencies, Bitcoin is gained up by 20%, 31% gains in Ether, 77% for Cardano, and 30% for Solana. And that's exactly the way that you've seen various other 20 to 30 altcoins behave. So you have seen very strong money flow into this one.
All right, thanks a lot for that, Manisha. Well, let's focus on the big interview then. We have Ola Electric. They reported their Q2 earnings, the company's numbers, missed street estimates. However, the operational numbers have shown an improvement. To discuss the quarter gone by, what's the way ahead? We're joined by Bhavish Agarwal, the chairman and MD of Ola Electric Mobility. Hi, Bhavish. Always good speaking to you. Thanks a lot for joining in here on CNBC-TV18. Well, the last time we chatted, you said that there is a path to profitability. You're going to be breaking even. Could you tell us in which quarter do we see this break-even point? And also your gross margins, they have improved to around 20% odd. And you've stated that it will gradually improve from year on as you get backward integrated. What's the number we should be working with on the gross margin front as well?
Nigel, always good to be with you. Thank you for having me early morning. On our quarterly results, it's been a quarter where the key message I want to share is the fundamentals of the industry and of our company are stronger. Fundamentals mean, firstly, penetration. The EV penetration is actually inflecting. In scooters, EV penetration is already above 20 odd percent, and in some states actually closer to 50%. So that means EVs are now being adopted by consumers en masse. It's at that inflection stage already. Our focus has been to continue market leadership and investing in growth while continuing on our path to profitability. And like you mentioned, a couple of highlights over there I want to share. Firstly, our gross margins continue to improve quarter on quarter. In Q2 over Q1, our gross margins had a 3-point improvement due to BOM cost reduction, but then we invested part of that back into growth. And over the next couple of quarters also, people will see a kind of a good journey of improvement on gross margins because our theme on manufacturing vertical integration, as well as the Gen 3 platform, all of it is coming together between this quarter and next quarter. And I want to actually highlight that our Gen 3 platform, which was scheduled for August next year, is actually coming out in January, in just 2 months. So we've actually been executing ahead of curve, ahead of schedule on that. And the Gen 3 platform over the next 12 months will actually bring about almost 20 points of BOM cost or margin enhancement on our gross margins. So that's a major initiative from our side. In terms of time to profitability or path to profitability, I think people will be positively surprised over the next couple of quarters on how our business, with improving gross margins, with improving scale of sales as well as new products, how the profitability actually comes into a very, very good shape over the next couple of quarters.
Well, the street will be looking forward to a timeline out there. And as you were about to address that point, when the stock moved to the high point of the day, we thought we're going to get the timeline. When do you think? First half of FY26 or the second half of FY26? And since you're saying that market share is another factor that you look at, you're still holding on to that 30% odd mark. Where do you see this number headed? And Bhavesh, give us a number. What's the targeted market share that you're looking at?
See, as a leader, Nigel, our target market share is about between 30-35%, right? So that's where we believe, despite competitive intensity, we'll be able to target. And our focus is not just market share within the e-scooter segment. Our focus is to now actually broaden the EV journey of India from scooters into motorbikes, into three-wheelers also. And in our quarterly call, we had shared an update on the timelines of our three-wheeler. While we in scooters expect to retain a market share of about 30-35%, we actually look forward to increasing the journey of electrification in these other categories. So all inclusive, our EV market share could be actually slightly higher than the 30-35% number, depending on how these new categories scale up. But market share is one, and then linked to volumes is operating leverage on the bottom line. And that delivers, I would like to say, good surprises in the near term on profitability.
So EBITDA margin positive in FY26. That's a given, right?
See, auto segment EBITDA margin was very close to positive even last quarter. So our auto segment EBITDA margins, one can assume in that timeline will be in the positive territory.
Okay. And even your gross margin goal, X of the incentives, is 30%. When will you achieve that, Bhavesh?
See, our gross margin journey, if I can just lay it out for your viewers, right now our gross margin is about 21% with incentives. All the incentives are not booked into it. PLI, I think we're booking only about 5-6% into that. So with Gen 3 platform, over the next 12 months, we'll get about a 20-point advantage on our gross margins. And you can see that's a very meaningful change because of our vertical integration and our technology. So that will play out over the next 12 months. And then our own cell, the 4680 Bharat cell, will be coming on in Q1 of FY26. So that will add another 7 to 8 points of margin. And then over time, over the next few years, as incentives go away, about 10-15% of incentives will go away. So that leaves about a 30-35% steady state gross margin. So that's our target. And we are moving every quarter on quarter, we are moving in that direction.
So say by FY30, is there a rough timeline?
FY30 might be a little too far.
So what are we looking at? When do you get to 30%?
The Gen 3 timeline is 12 months. The savings start next quarter onwards, and then they kind of add up over the next 12 months. So all that 20 points will actually be over the next 12 months. And our cell is also in the next 12 months, like I said. So all this roadmap is actually a couple of years of roadmap. This is not a long-term 5-year roadmap.
Okay. Bhavesh, if we talk about deliveries, while the mass segment has seen a growth of 15% sequentially, but your premium segment, it contributes major chunk of the revenue, has seen a fall both on a sequential and on a YY basis. Is it because of a change in the strategy or the growth mass segment because of heavy discounting that you've been offering? What explains that and what is the outlook here?
See, one point I want to say is because of our platformized approach, we have a very similar gross margin on premium and mass products. It's not like the mass products have a very low gross margin and the premium has a very high gross margin. That's why despite the mix change over the last quarter and this quarter, you can see the margins are actually broadly held stable. So you can expect that going forward also, that our margins are similar across premium and mass. And our strategy actually remains to grow in both segments. With our Gen 3, you will see us launch a refreshed premium set of products, as well as a refreshed and an extended mass portfolio. So we expect both our segments to grow. And broadly, in the end, our volumes will reflect the industry, because we are playing across industry segments. We're not just a premium player. We're not just a mass player. We are playing across 2 and 3 wheelers across all segments of the market. So broadly, volumes will reflect what the industry structure is.
So is there a number, Bhavish, to both the segments? Since you're focusing on both, how much will they grow by? Will they grow equally, or will one segment do better than the other?
See, for the foreseeable future, I expect about 1/3 of our volumes to come from premium and about 2/3 from the mass. That would mean revenue of about 50-50. Right?
All right.
Yeah.
Got it. Bhavesh, you have mentioned in the past you're looking to address the servicing issues. And that's going to be the big point that the street will be looking forward to as well. So shareholders, they look at the stock price performance, and your customers will be hoping for better service. Tell us, what are you doing about this? And I want to highlight 2 parameters. One is how many service centers you have, and where do you see the number headed to? Point number 1. Point number 2, how many mechanics you had in the first half of the year, and how much higher will it be in the second half of the year? Please go ahead.
Nigel, very relevant and topical point. I want to start by saying service, the whole noise around service that we had seen a month or so ago is behind us now. We had a temporary increase in service outstanding backlogs because we had not expanded capacity fast enough in the last 6 to 8 months. Now we have addressed that. So any service backlogs are all history now. We are now doing more than 80% service requests within T+1 days. That means if you bring your scooter today, we will service it today or tomorrow. 80% of such issues are resolved in T+1 days. In terms of capacity, we've also in the last 2 months expanded capacity significantly, both in terms of number of centers. We were around 500 maybe a quarter ago, and now we are above 600. And also in terms of the number of mechanics, we are, each of these 600 stores is staffed with multiple mechanics now. So in the last quarter or so, we have expanded capacity by about 20%. Our focus in the next 2 quarters, let's say by March of 2025, is to get to about 2,000 stores and about 1,500 or so service centers also. And this is, we are executing on this roadmap. We should be able to achieve this by March.
Okay.
Yeah.
What is the current service backlog, Bhavish, and what was the average resolution time earlier, and what is it now?
The service backlog is all history now. In the middle, it had spiked, like I said, because we had not expanded our sales volumes in the last 12 months had expanded a lot, and our service volumes had not expanded. Service capacity had not grown in sync, and now we have fixed that operational issue. So there is no backlog. Generally speaking, there would be a few anecdotes here and there, but no backlog of any service issues. More than 80% are serviced within a day. Right? This number, let's say a month or 2 back, was maybe 15 points lower. So we have significantly improved, and there is still some headroom for improvement, which we are working on for this quarter and the next.
All right. Bhavish, you fielded most of our questions. Have given us a fair idea about things going ahead. But I need to ask you about the share price. And being a promoter who's built this company over the years, you will know the actual value of the company. Your peer, Mr. Rajiv Bajaj, doesn't stop short at saying that he believes Bajaj Auto should be 20,000 rupees per share. What about you? Your stock price is at 75 rupees. What do you think is the actual value of the stock price? Go for it.
Nigel, we are building the future at Ola Electric, right? We are the EV leader. The future is going to be EV, especially in the 2 and 3 wheeler. And we have the strength in technology. We have the strength in manufacturing, especially for EVs. And we have the strength in distribution. So I think shareholders are seeing strong value in our story. Share price will move up or down here and there. I'm not bothered about daily movements of share price. But our focus is to really build the future of the automotive segment, automotive industry with Ola Electric. And we are allocating capital wisely. We are on the path to profitability. So I do expect shareholders and prospective shareholders to join this journey and really build the future with us.
Very quickly, Bhavesh, on your interest cost in the past quarter, it was around 85 crores, but now you've got the money from the IPO as well. Could you tell us, that interest cost comes down, right? Because you'll repay bulk of the debt. Yeah. What's the quarterly run rate?
Yeah, the debt will get repaid most likely in the next quarter or later this quarter. So that that'll bring down debt by roughly, I think, 25-30% overall. But some of the project finance will remain. The project finance, which is for the Gigafactory, etc., that's more long-term debt. That's not what we will repay. We'll repay most of the working capital. Because the working capital cycles have also now stabilized with our the government receivables or the FAME or the supplier payouts. The working capital is stabilizing, so now we believe we will not need long lines to run that.
Okay, Bhavesh, thanks a lot for joining in here on CNBC TV18. You've got your eye on turning profitable. You're looking at backward integration, holding on to your market share. And as you said, the service requests are now being addressed. Thanks a lot for speaking to us here on CNBC TV18.
Thank you, Nigel.
In fact, the stock is now up close to about 2.5%. In the morning, it was in the red. It was down about 2-odd%. But now, as Mr. Agarwal was speaking, the stock is now inched up. By the way, the Nifty is also now above 24,300. So the recovery there continues. The Nifty Bank, in a span of 30 minutes, has added on close to 150 points. So now it's 600 points up on the Nifty Bank too, so climbing higher and higher. So as CNBC TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC TV18 Global Leadership Summit on the 14th of November, starting 10 a.m. onward. It's a power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only and only on CNBC TV18.
Welcome back. You're still tuned into Trading Hour. Well, one of the stocks of the day has to be Aarti Industries. It's down 8%, reported a weak set of second quarter numbers. The revenues increased by 12%, but the profit after tax, margins and EBITDA saw a big fall. Company has also lowered FY25 EBITDA guidance following the weak quarter. Joining us now is Suyog Kotecha, who is the CEO and Executive Director of Aarti Industries. Suyog, good morning. Thank you so much for joining in. And this decline that you've seen in margins has come in after 4 quarters of sequential improvement. What were the issues this time around? Pricing pressure continued in your MMA portfolio, but how long before MMA starts to see a recovery?
So it was a challenging quarter, Sonal. I think as we had mentioned last time, the volume recovery, the demand recovery, we continue to see in a majority of end markets. The polymers, the dyes and pigments continue to do pretty well and going steady. AgChem continues to remain soft. And as you mentioned, MMA, which goes into energy application, did see significant headwinds during the last quarter. And it was driven by a very steep drop in the refining margin portfolio. So globally, the gasoline naphtha differential as well as gasoline crude deltas collapsed quite significantly. And that was the reason we saw pressure on the demand for the MMA.
Okay, so are we seeing some improvement right now? And is it impacting just volumes, or is there an impact on realizations as well?
So on the energy segment specifically, there is an impact on both volume as well as realization, because the downstream end market margins have sort of compressed quite significantly. And as we speak, we see partial recovery, but it does remain subdued compared to where it was around a year back.
So, what does it do to your EBITDA guidance? You had refrained from reiterating that in quarter 2. Now you're scaling it down. And what happens to your long-term EBITDA guidance over years that you had provided us earlier?
I think we have in the analyst meeting yesterday, we have given new EBITDA guidance. I think this year we are expecting to close at around 1,000 to 1,050 odd crores, which is the visibility we have as on date. Our 3-year target still remains to double the EBITDA from the current level. So we have given a 3-year guidance of FY28, where we expect to land around 1,800 to 2,200 crores of EBITDA, along with much better ROCE numbers and much better debt to EBITDA numbers.
Okay. So you're investing a lot in different streams. So whether it's CRAMS, you're moving up the value chain now. That's the plan with Aarti Industry. Do you think that this is something that will be volume driven, or it will be margin driven, since you are planning to double your EBITDA in the next 3 years? What will be the growth driver? Will it be traditional portfolio or the new products that you're entering into?
So I think next 3 years EBITDA is predominantly driven by initiatives which are already in the play. And I think we have also given this time enough clarity in terms of where do we think this EBITDA will come from. We are expecting roughly 150 to 200 crore to come from several cost optimization levers, which are fully in our control. We are expecting roughly 350 to 550 odd crores to come from volume and margin ramp up of existing product portfolio, where we have recently expanded capacities, but the volume ramp up is expected to happen over the course of next 1 to 2.5 years. And then roughly 350 to 400 odd crore kind of coming from the new capex which we are putting in, which will be a little bit back-ended towards the second half of this 3-year kind of a leg. So that's the rough split of where we expect the EBITDA growth to come from.
Okay, so Suyog, a lot of other players, they've been talking about recovery in the second half, but then they also said it could move to next year. What's your sense? Is this an industry-wide problem and recovery could come by only FY26 versus Q2 of FY25 that was expected earlier?
I think to some extent it is an industry-wide problem, though for individual players, depending on the value chain they're present in, I think the time frame of recovery could look very different. But at an industry level, it is a fact that post-COVID era, China built significant capacity across value chains, which is coming on stream right now. And unfortunately, that is getting combined with a lack of domestic demand in China, which means they're forced to dump these volumes all over the world, which basically leads to margin pressures for players around the world. And that is the phenomena we are going through right now. And as you said, recovery, the timeline of recovery will vary depending on the value chain in which you're presented.
You had a lot of capex lined up. Now, most of it is done. So what is the debt now? I think the last number we had was about 3,000 crore rupees. So if you could give us an update, what will you end the year with, and even next year?
Yeah, so I think, as we mentioned last time, we are expected to peak around 3,500 kind of level from a debt point of view, and then it will marginally go down. I think our capex guidance also for this year is in the range of 1,300 to 1,500 crore, which is slightly lower compared to previous number of 1,500 to 1,800 crores. And next year, the capex number will go down even further. We are expecting around 1,000 crores of capex next year.
Okay, that's 1,000 crore of capex next year. I also wanted to understand the export picture, especially on the back of Red Sea crisis, because a lot of companies spoke about how freight prices went higher. Does it still continue? Are these costs still higher? And does it impact your export demand in any way? Or also the container availability, is that a problem?
So from a freight point of view, it was an issue during Q2. I think we continue to see significantly higher freight rates, especially sort of in the west direction. But however, we have seen softening of that in the last 2 weeks, and we hope that trend will continue going forward. From a container availability point of view or servicing demand point of view, I think that challenge does not exist. I think we're doing pretty okay on that front. But from a freight cost point of view, Q2 was still at elevated levels, but we've seen softening in the last few weeks.
Okay, that is some positive news for the industry and exporters otherwise as well. Suyog, thank you so much for joining in today and giving us all those details. So that's the word coming in from Aarti Industries. A multi-quarter low margin number that we are seeing. They've scaled down their guidance as well. And that's why that 8% knock on the stock that we are seeing today. We'll slip into a short break, but when we come back, we'll talk about more stocks and news updates on the other side. Stay tuned.
Welcome back. Now, Tata Motors is one of the big gainers of the day, 2.5% higher on the stock despite a weak set of second quarter numbers. So what's aiding the up move? Sudarshan joins in. Sudarshan.
So Tata Motors has made a sharp recovery from intraday low. It's almost up 3% from intraday low and now is trading with a gain of more than 2%. Now, it's on the back of positive management commentary company has given after Q2 earnings. Earnings were below estimates. Both Tata Motors and JLR have disappointed on the earnings front. But on the outlook, JLR has maintained its EBIT margin guidance of at least 8.5%. Even Tata Motors sees H2 FY25 to be much better than H1 FY25. If you remember, like Ashok Leland in the chat company had with CNBC-TV18 company said that H2 FY25 might have CV industry growth in the range of 6 to 10%, and for FY25 growth might translate in the range of 0 to 3%. So considering all these factors, Tata Motors stock has made a recovery from intraday low. Even brokerages are largely positive on the stock. CLSA has upgraded the stock to outperform and target is rupees 968 per share. Nomura 2 maintains buy call and target is cut to rupees 900 from 1300 per share. It says strong rebound in JLR in H2 FY25 likely. Also, it expects India commercial vehicle recovery likely by Q4, and JLR's performance across markets has been better than peers even in Q2 FY25. Jefferies 2 has a buy call. Target is cut to rupees 1000 from 1330 per share. Only UBS has a sell call and it has a target of rupees 780 per share. It says quality of reported EBIT was disappointing in Q2 FY25 earnings. So earnings were a miss in Q2, but outlook given by both JLR and Tata Motor has helped the stock to recover from intraday low today.
All right, so that's the reason for that recovery. Thank you so much, Sudarshan, for joining in with all those details. Small finance bank companies, there's Equitas SFB, Utkarsh SFB. There's also Satin Credit Care, which is in focus on the back of second quarter earnings. Abhishek is here with the earnings fine print.
Well, microfinance sector is under pain and we are seeing the continuity with respect to deterioration in asset quality and pressure on the lenders with respect to return ratios or the bottom line. So Equitas for small finance bank, the weak return ratios have continued for second quarter in a row. The slippages are elevated. It has increased by 31% quarter on quarter, but the slippage ratio at 5.5% is on the higher side. That compares to about 4.4% in the previous quarter. Asset quality has deteriorated. Gross NPA ratio and net NPA ratio have increased. The net interest margin is at multi-quarter low. It has declined by 28 basis points sequentially to 7.69%. Both the NI and PAT is way below our poll. PAT is at just 13 crore versus our poll of 157 crore. Utkarsh Small Finance Bank, the asset quality has deteriorated. Slippages have increased by 250% on a sequential basis. So the annual slippage ratio is one of the highest that you are seeing in the industry, close to 7.5% for Utkarsh Small Finance Bank. Their gross NPA ratio and net NPA ratio have increased. The disbursements are down both YOY and quarter anywhere between 15 to 16%. AUM growth is weak at just 1.5% on a sequential basis. Operating profits, they have declined by more than 11% quarter, while provisions are elevated. Our provisions have increased by 150% YOY and about 67% on a sequential basis. So there was pressure on their earnings as well. So PAT declined by 55% YOY and about 63% sequentially. Satin Credit Care, they have cut their FY25 AUM growth guidance to anywhere about 8 to 10% now from the earlier guidance that is in Q1 FY25 con call of about 20%. The AUM growth is weak at 0.4%. Asset quality has seen massive deterioration. Operating profits have declined while provisions have increased tremendously, and that is why the PAT is down 60 to 63% on a YOY and sequential basis. Back to you.
All right, that is all about microfinance sector. Thank you, Abhishek, for joining in. So those stocks are under pressure. Time for a short break now. When we come back, we'll get you the key expectation from Britannia's Q2 results that are expected today. Stay tuned for that. Welcome back. Well, earnings season towards the end, but we do have a lot of nifty numbers which we are expecting. Britannia is one of them. Mangalam is here to get us the key expectations. Mangalam, what are we expecting?
Well, for Britannia, it may be a lot better than what we've seen in all the other consumer companies this time around so far, largely because, the products that Britannia sells, the ones which were under pressure earlier, which is the mass segment, is now beginning to show signs of recovery, given recovery in the rural areas itself. So to that extent, we are expecting a near 9% sort of volume growth that we will see. The stock is down about 12% from the highs itself. But because of the price cuts that the company has taken, maybe the revenue would grow just about 6%, implying a 2 to 3% sort of price cut itself. We're expecting a revenue just shy of that 4,700 crore mark. On the EBITDA, though, because of increase in palm oil prices, we may see quarter-on-quarter, decline. Year-on-year as well, the EBITDA is likely to grow just about 2%, and that will reflect in the bottom line as well, where we are expecting no more than a mid-single-digit growth for Britannia. Volume growth would be extremely crucial to track. This time, the street is working with a range of anywhere between 8 to 9 odd %. But more importantly, what we need to know apart from these numbers is the commentary on demand sentiment, on a lot of those adjacencies beyond biscuits that the company is looking to grow, and also at the same time, some sort of competition is something that we will watch out for Britannia.
Okay, all right. So that is what we're expecting from Britannia. The stock at the day's low as we speak. But it's time for a short break. When we come back, we'll get you more on the markets and stock-specific action. Stay tuned for that. Welcome back. Well, the Nifty has come below the 24,300 mark, but still, of course, there's been a big recovery from the lows of the day, up around 150 points. The mid-caps are recovering a bit more, so it's just a 100-point cut on the mid-caps that we are talking about. Around 1,000 stocks on the advancing side versus 1,400 stocks on the declining side. So the mid-cap index is also at the day's high. So is the small cap index, which has recovered from the lows. The IT pack, the bank Nifty, these two are the contributors to the recovery that we're seeing from the lows of the day, and that continues to be the focus point. The likes of Biocon, Gland Pharma, these stocks are higher in trade on the back of news updates, and we'll keep tracking market moves for you. But for now, we are completely out of time on this edition of Trading Hour. Stay tuned. Halftime Report is up next.